On January 7, 2009, the chairman of one of India's most powerful tech companies sat down at his desk and wrote a letter, not to his lawyers, not to regulators, to his board of directors. 5 pages, and in those 5 pages, Ramalinga Raju confessed that everything, every profit, every cash balance, every employee count had been a fabrication. For years, his company was called Satyam. In Sanskrit, that word means truth. Raju wasn't born into wealth. He grew up in a small farming village in Andhra Pradesh, in southern India, where his father worked the land. He got an MBA from Ohio University, came back home and tried his luck, first in hotels, then in cotton spinning. Both failed. But in 1987, he found his real bet, software. He called the new company Satyam Computer Services. The timing was almost perfect. In the late 90s and early 2000s, American and European corporations were racing to outsource their IT departments. India had the engineers, the English speakers, and the cost advantage. Hyderabad became India's answer to Silicon Valley, and Satyam was first in line. 185 Fortune 500 companies signed contracts. General Electric, Nestlé, the U.S. government, PricewaterhouseCoopers, one of the 4 most powerful auditing firms in the world, signed off on every annual report. Satyam listed on the New York Stock Exchange, with shares peaking at $29. Revenue was reported at over $2 billion. Workforce, 53,000 employees. In 2008, Satyam received the Golden Peacock Award for Corporate Governance, India's highest recognition for ethical, transparent business management. Raju stood on stage. He shook hands. He smiled for cameras. And at that exact moment, the fraud had been running for at least 5 years. So how did he do it? Accounting fraud doesn't look like a heist. No masks, no getaway cars. It looks like a spreadsheet. And when you control the spreadsheet, you control reality. Raju's team didn't just falsify documents. They hacked Satyam's own software. They broke into the invoice management system and rewrote part of its source code. They created a hidden user ID, invisible to anyone not specifically searching for it. With that access, they could generate or erase invoices at will. Over time, they created more than 6,000 fake invoices for work that was never done. Then came the Ghost Army. Satyam claimed 53,000 employees. Around 13,000 of those people did not exist. Fictional names entered into the HR system complete with work hours and salary records. Every month, those ghost paychecks, roughly $4.5 million, were redirected into private accounts controlled by the Raju family. Month after month, year after year, and the cash, the company reported over $1 billion sitting in bank accounts, nearly half of all reported company assets. The auditors reviewed the bank statements. The statements looked perfect because they were forged. Nobody called the banks to verify the actual balances. One phone call would have ended everything. The real money went into land. Raju had quietly built a private real estate empire across Andhra Pradesh, funded through 356 shell companies. One of those shells, registered with just $9,500 in capital, received over $100 million in undisclosed loans that never appeared on Satyam's books. And while all this was happening, Raju was selling. Between 2003 and 2008, his family sold 30 million shares, reducing their stake from 25% to under 5%. In public, bullish on Satyam. In private, already on his way out, it started as desperation. He borrowed from the company to fund real estate bets. When prices moved against him, he covered the hole with fake numbers. The company kept growing, the hole kept deepening. The fake numbers had to grow with it. He later put it this way: it was like riding a tiger, not knowing how to get off without being eaten. The signals were visible. They just required someone willing to look. Satyam was reporting profit margins that beat Infosys, Wipro, and Tata Consultancy Services, its direct competitors. But simultaneously, it was generating less revenue per employee than all three. In a service business where humans are the product, that math is impossible. You cannot be more profitable while being less productive unless you are lying about one of the two numbers. Forensic accounting models had flagged Satyam as being in the worst 2% of all globally listed companies for accounting quality, as early as 2002, 7 years before the confession letter. That data was accessible. Nobody in a position of authority acted on it. Then, in December 2008, Raju made his final move. He proposed that Satyam acquire 2 family-owned companies, Maytas Infrastructure and Maytas Properties, for a combined $1.6 billion. A tech company, buying construction firms controlled by the chief executive's own family. The board said no. Investors revolted. The stock dropped 55% in a single day. One detail worth sitting with, Maytas is Satyam spelled backwards. With no exit left, Raju sat down and started writing. January 7, 2009. The letter reaches the board. Raju resigns immediately. He is arrested 48 hours later. Satyam stock, which had traded above 500 rupees months earlier, collapsed to 6 rupees, a 98% wipeout. The New York Stock Exchange suspended trading in Satyam shares immediately. Merrill Lynch cut ties the same day. India's government dissolved the board and seized control of the company. 40,000 real employees showed up to work, not knowing if there would be a paycheck. Investors across India, the United States, and Europe watched their holdings become nearly worthless overnight. After 6 years of legal proceedings, Raju was convicted in April 2015, along with 10 co-conspirators, and sentenced to 7 years in prison. PricewaterhouseCoopers paid a $6 million fine to the U.S. Securities and Exchange Commission and was banned from auditing any listed company in India for 2 years. What remained of Satyam was acquired by Mahindra & Mahindra and rebuilt as Tech Mahindra. The company that won the top corporate governance award of the year was a fiction. Its auditors signed off without making one verification call, and the company named Truth became a permanent warning. So what do you actually do with this? First, a famous auditor's name is not a guarantee. PricewaterhouseCoopers never directly verified the cash with the banks. They reviewed statements that were forged. Before investing in any company, understand what the auditors confirmed, not just who signed the cover page. Scope limitations in an audit report are not fine print. They are a warning. Second, in any service business, productivity and profit must move in the same direction. If a company reports higher margins than every competitor while generating lower revenue per employee, that gap is where the lie lives. Run that comparison across peers yourself. It takes 15 minutes. Satyam's discrepancy was sitting in the public data for years. Third, watch what founders do with their shares, not what they say in earnings calls. Raju sold 30 million shares over 5 years while publicly backing the company. Insider trading disclosures are public records in most markets. When executives quietly reduce their own stakes at scale, that is a verdict, not a coincidence. And fourth, when a chief executive tries to use a public company to buy his own private business, walk away. Related party transactions are disclosed in annual filings. Almost no one reads that section. That is exactly why fraudsters use it. Satyam was not buried in complexity. The fraud survived because no one looked at the numbers that didn't add up, at the company name spelled backwards, at the shares being sold while the speeches were being made. The next one is already running. Subscribe to Capital Sins, and you will learn to see it before the crash. If this story changed how you read a financial report, hit like, and click the video on screen for our next investigation. Another empire, another confession, another fall that the numbers predicted years before anyone listened.